Hi guys. Today we will analyze Sherwin-Williams stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The long-term trend is still negative, but the short-term trend is positive. Strong support levels are around $219 and $200. Next strong support levels are around $180 and $160. Strong resistance levels are around $250 and $273. Next strong resistance levels are around $282 and $311. In the last month the stock has been trading between $214 and $252 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1.7 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 11% per year, for last 5 years. We see that the average profit margin of the stock has been around 9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 126% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Sherwin-Williams Company: bad, average, and good. First scenario. Sherwin-Williams will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 6%. Future profit margin would be low, 7%. Future free cash flow to net income rate would be low, 90%. In this case, the fair value of the stock today would be $114. Second scenario. Sherwin-Williams will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 7%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $140. Third scenario. Sherwin-Williams will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 9%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $169. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 6.87. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Sherwin-Williams, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 26. Again, I will use 3 different scenarios for Sherwin-Williams Company: bad, average, and good. First scenario. Sherwin-Williams will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 6%. Future P/E would be low, 20. In this case, the fair value of the stock today would be $98. Second scenario. Sherwin-Williams will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 7%. Future PE would be average, 23. In this case, the fair value of the stock today would be $123. Third scenario. Sherwin-Williams will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 26. In this case, the fair value of the stock today would be $151. As you can see, today the stock is overvalued, $245, even if we expect the company's high performance in future. While the company has a neutral profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower before it recovers. The stock is a dividend aristocrat. I may consider buying the stock for the dividend when the stock drops to $160. Company's strengths. Sherwin-Williams is the largest U.S. producer of paint, coatings and related products. The company operates over 4,100 retail stores, and supplies coatings directly to retailers, distributors, industrial and commercial customers, and other industry professionals. It has operations in over 120 countries. As a global leader in the paint and coatings market, the company's size, scale and brand awareness are significant competitive advantages against related peers. Professional painters have favored Sherwin products for decades, leading to strong brand loyalty and pricing power. The company's acquisition strategy should boost sales and expand its geographic reach. Sherwin's exclusive partnership with Lowe creates an additional avenue for the firm to sell its products to new customers without meaningful cannibalization risk. The company is a dividend aristocrat. It has raised its dividend for impressive 43 consecutive years. The stock currently has 0.98% dividend yield. The company's return on assets of 8% and return on equity of 68% are amongst the best of the industry. It has a profit margin of 9%. This is better than the industry average of 7.4%. Risks. Sherwin's investors face risks related to the highly cyclical nature of the company's end markets, particularly construction, housing and manufacturing. Residential repaint surged during the COVID-19 pandemic, which could result in a near-term glut. The company's margins are sensitive to raw material prices. Higher titanium dioxide or petrochemical prices could lead to margin contraction if Sherwin is not able to pass along those costs to customers. Sherwin has continued to open roughly 100 company-owned stores per year, but saturation could become a concern. If fewer stores are opened, overall growth could slow. The company also faces risks related to the integration of its many acquisitions. The company has a high debt level, due to recent acquisitions of Valspar and Specialty Polymers. Sherwin is exposed to some environmental, social and governance risks. Regulations around chemicals have increased in recent years. In order to support the stock's current price, revenues must grow at double-digit rates for the foreseeable future, which is unlikely. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 10 to 12% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.